Bill 1234 is a collection of a number of bills that we got dealing with a number of our oil and gas tax issues. To start out with, it will remove all the triggers that we currently have, which could be a very big thing for the state of North Dakota in our planning for future budgets. It also removes all the incentives that we currently have on the books. It also addresses the stripper well definition that we currently have on the books. Currently, if a well is declared a stripper well, the field that it's located in, all future wells in that field are called stripper wells. And they receive the 5% tax only and don't have to pay the 6.5% extraction tax. Under this bill, the definition is changed so that each well has to achieve the stripper well status on its own production, not on a production of another well that could have been there for a number of years. Currently, they project 70 wells that are Bakken wells are classified as stripper because they're in a stripper field. That's quite an impact on our financial institution and on the tax rate. This does affect only the Bakken and Three Forks. We have three different levels of three different fields, the 0 to 6,000 feet, 6,000 to 10, and the 10,000 below, which is the Bakken and Three Forks. So it also changes the qualifications to a stripper well from the 30 barrels or less to 50 barrels or less on the Bakken Three Forks, because we recognize the cost, the high cost of drilling a Bakken Three Forks well, so we give them a little better chance to recover and also work it. It also establishes a new stripper well definition, and what that is, when they go in and rework or re-drill a stripper well, which is at a 5% well, currently it'll stay at that 5%. Under this bill, they would have 1 year to recover that cost, then it's automatically inspected by the state and to see what level of production that well is at. If it's at the 50 or below, it'll still continue to qualify as a stripper well. If it's at 50 to 100, it'll qualify at a 7% rate, and if it's over 100 barrels per day, it'll qualify for the regular rates that we charge all other wells. It does take 3 months of production in order to qualify, or it takes 12 months of production under that 50 barrel or 100 barrels to make that qualification. The bill goes on to address the current tax rate that we have on all our wells, and it puts up a 3-tier tax system. If we hit 800,000 barrels of production a day for 3 months solid, the tax rate will reduce from the 11.5% overall to 11%. If we hit 900,000 barrels a day in production in North Dakota, the tax rate will again drop another 0.5% to 10.5%. When we hit 1 million barrels a day, and we're projected to hit all these within the next couple of years, when we hit $1 million a day, 1 million barrels a day in production for 3 months running, the tax will drop to 10%, and there's where it'll stay. There's also a date certain for July 1, 2015. Now, this would drop our income from each barrel of oil, but we'd also be increasing our income because our production is going up. It'll also, the changing the definition of stripper wells also increases our production considerably to offset what we're going to be what we wouldn't lose, but what we wouldn't get from the 0.5% drops as they come into play. So when we talked to the code reviser and the estimator, they could not give us a fiscal note because they couldn't project if there's a win or a loss on it. When we first introduced the bill on just a stripper well, it was a $105 million gain on it. When we changed the barrels from 30 to 50 to qualify, that dropped that fiscal note, and we added, when we came in with that 2% additional for the additional stripper wells, we had no idea where that would fall because we have no history. And of course, when we dropped the 0.5% over projected growth, then it balanced out. So as far as we know, there is no fiscal note on this. Your committee voted 10-3, a due pass, and we hope you'll concur.
Is there any discussion? Representative Onstead.
Thank you, Mr. Speaker. Will the bill carrier yield to a question, please?
Representative Drogdahl, would you yield to a question?
Mr. Speaker, I will.
Representative Onstead.
Thank you, Mr. Speaker. Representative Drogdahl, why did we limit the stripper wells to only the Bakken and Three Forks formations?
Mr. Speaker and Representative Onstead, we've had no complaints on the other two fields because we haven't gone, well, supposedly because we haven't done horizontal drilling and it doesn't work in the other two fields, so there was no need to address that, and there was no amendment offered to address it from any of the committee members either.
Could I ask the Speaker another question? Or Mr. Speaker, can I ask another question?
Representative Onstead, you may ask another question.
Thank you, Mr. Speaker. If you go to page 6, line 18, where it's talking the incremental part, when it says 6% for production wells drilled and completed on or after that first day of the third calendar, once we reach the 800,000 barrels. Does the original wells up to that point, are they still taxed at 6.5%, and it's only from that point on they're at 6%? And then if the same language is used in the other increments as it goes up. And so what I'm saying, are all the wells going to be at 6%, or the first wells before that plateau, do they stay at 6.5%, the next one go to 6%?
Mr. Speaker and Representative Onstead, that's a very good question, and I did miss that in my presentation. This only affects the new wells after the rates go in. All the old wells that are already producing will stay at the existing rate, so they will stay at 6.5% or 6% or 5.5%, whatever that rate would be.
Thank you, Mr. Speaker. May I continue?
You may continue.
A couple things that I want to address that deals with, and particularly it's about stripper wells. One thing across the nation, the average well production for stripper classification is 10 barrels per day. 10 barrels per day. And we've taken this from 10, 15, 30 and actually went up to 50 barrels per day before they qualify for a stripper. Okay, we look at certification. Tell me what the reasoning is to ever get that production above 100 barrels per day once you receive stripper status. You're a businessman. You're going to see increased costs. Why would you raise it above that level? We've already raised the bar from 30 to 50, which is now 40 barrels per day higher than the national average. Okay? Now we turn around, they do some new tertiary efforts to that whole point, and it has to get over 100 barrels per day to get into that next tier. Again, I'll ask the question, why would anybody want to improve that level above that point? Because they're going to be pretty happy with that zero tax bracket and extraction tax on those stripper wells. I find that portion of the bill the most troubling of that. And then to limit to only 2 formations. There's like 20-some formations in the Williston Basin. 13 seem to be economically feasible to be drilled with the new technology. And yet we only want to limit this to the 2 because of, for whatever reason it is. You know, we have Tyler Formation that's coming on board. We have the Spearfish Formation. They've been there. The horizontal technology is going to be used there, and yet we're going to exempt those from this particular provision. A couple comments about oil development. Those companies are not here about the tax structure. They're here because of geology, technology, and the availability of oil. I know those costs are as such, but they pretty well drilled out their leases at this point, so it isn't a panic to drill. They're able to now renegotiate rig costs. They're able to renegotiate what their fracking costs are for those particular companies. So that's coming down anywhere from 30% to a little higher that I've read in the papers. And so to say that we need to increase that reduction or that tax reduction, we've already given them a corporate tax reduction at that point, and why does this have to continue? Are we saying it's going to continue because we need increased production? You can go back and look at SEC, Security Commission's reports on many of the oil companies that are currently in North Dakota today. Their profits are at record level. They're all making statements that they plan to triple production. And this was back late last fall, last summer. They're going to triple the production because of geology, technology, and the availability of oil. They're not going to deal with, they're happy to give it, they're happy to get that tax break, but at this time when I recognize the billions of dollars in needs across the state, I'm not sure that this is the right time. We look at the bill, I think the real problem is the stripper portion of the bill, and I think that should be addressed, and I hope we can vote no on this particular subject. Thank you, Mr. Speaker.
Representative Striley.
Thank you, Mr. Speaker. Mr. Speaker, members of the Assembly, the reason I introduced this bill, and it was obviously part of an amendment last session, but if you look at the bill, what it does, 800,000 barrels, all new production, 900,000 and a million, half a point at each, only on new production. What it also does is removes all the exemptions. Look at how many pages of tax policy we have. There isn't a single person that understands it because it's very complex. What it also does is closes the stripper well exemption piece, which is a major, this will actually increase taxes on them if you look at it. So that's why this bill is a net neutral, no loss in revenue. Our budget's based on 850,000 barrels. So anything over that, there is no, if we can live within our means with that, we don't need this additional revenue. And like I said, with the stripper well exemption, it is a problem on the properties. And this will clarify and fix that issue. Like I said, the complexity of this thing. The trigger is a huge issue. Everybody says oil prices will never go back down. Well, we said that in 2009. We came one day away from that. This, removing the trigger of the 5250, provides budget certainty for the state of North Dakota. It makes it a lot easier for us to project our revenues. If this trigger ever hits now, it'll be $1 billion or more in lost revenue. So there is some give and take here. They're giving up the exemptions. We're giving up, the oil industry will be giving up the trigger in return. So we're increasing taxes essentially in that piece. All this is doing is reducing it to roughly 10%. Should we hit 1 million barrels a day, and only new production. It doesn't have anything to do with the previous 700,000 barrels of oil. So that's the point, is to simplify the tax structure, remove the trigger, which is a huge problem, I think, for North Dakota. And if anybody thinks oil prices and commodity prices don't fluctuate, you're kidding yourself. We do have a bunch of risks to the industry. We've got EPA, Bureau of Land Management, fracking, banning of fracking, air quality stuff. There's a bunch of risks to the state of North Dakota. Our budget right now is 43% just on the oil piece of it, dependent on oil. You add in the income tax, the sales tax they're paying, you're pushing into the 55% tax at least on what they're paying. Competition, yes, we do have obviously a very good formation. There is competition out there. If you look at the rest of the world, everybody is developing the shale. The Eagle Ford in Texas is the one I like to compare it most to. Currently, they have about 285 drilling rigs running there. We're in the 180 range. The Permian Basin in Texas has over 500, give or take. So to say that, yes, we know we have a good basin, but there is global competition for this, and our costs are the highest in the world for drilling. Yes, they are coming down. We're over $9 million per well to drill. The Eagle Ford is in the 6 to 7 million. They have a better climate. I don't mind the cold, but they have a better climate to work in. They don't have the housing issues, the road issues, the infrastructure. So to think that they won't just shift a couple $1 billion in the boardroom to move some 20, 30 rigs out, that is a real possibility with our tax structure. You look at Texas, they're at 9.2% tax. We're at 11.5%. Obviously, there's a few exemptions there and stuff too, but a lot of the companies we have, EOG, Statoil, Marathon, they're all operating in the Eagle Ford. With one decision in the boardroom, they can move that money. So we need to simplify this tax rate, get rid of the trigger, get rid of some of the exemptions,
Simplify this. This is an economic thing. We want these guys around here for the next 20, 30, 40 years. We need a lower rate. We need it simplified, and I would hope that we'd pass this bill.
Is there any further discussion? Seeing none, the House has before it for final consideration House Bill 1234. The clerk will open the key and you may record your vote. Has every member voted? Does any member wish to change their vote? Key will be closed. The clerk will take the record. The final vote shows 72 yea, 21 nay, 1 absent, not voting. House Bill 1234 is declared passed.